Welcome back to Calm Investors. I am Ruth.
And I am Patrick and Ruth. I have a story that I think is going to be perfect for today's topic.
Let us hear it.
Okay, so last month I found a $20 bill in my jacket pocket, one of those jackets you have not worn in a while. Reached in, pulled out a 20 nice, right? Little bonus made me smile for about 5 minutes.
That is a good feeling.
It was, but then this week, I lost a 20. I think it fell out of my pocket at the grocery store. And Ruth, I am still thinking about that lost 20. It has been 3 days. The found one? I forgot about it in an hour. What is wrong with me?
Nothing is wrong with you. In fact, what you just described is one of the most well-documented phenomena in all of behavioral science, and it won a Nobel Prize.
My lost 20 won a Nobel Prize?
Well, the research behind it did in 1979. Two psychologists named Daniel Kahneman and Amos Tversky published a paper called Prospect Theory. Kahneman later won the Nobel Prize in Economics for this work in 2002. And what they discovered is this. The pain of losing something is roughly twice as intense as the pleasure of gaining the same thing.
Twice as intense, so losing $20 feels as bad as finding $40 feels good?
Roughly, yes. This is called loss aversion, and it is not a character flaw. It is not weakness. It is hardwired into your brain. Every human being on the planet experiences this asymmetry. Losses feel about twice as painful as equivalent gains feel good. And this one quirk of human psychology drives an enormous amount of bad financial decisions.
Okay, so how does this show up in investing? Because I can see how it matters with a $20 bill. But what does it do to your portfolio?
It does two very specific things, and both of them are devastating. The first one is this: when you own a stock that is going up, a winner, loss aversion makes you want to sell it quickly, because your brain says, lock in the gain before it disappears. You have something good. Protect it. Take the money and run.
That makes sense. You do not want to lose what you have gained.
Right. But here's the second thing. When you own a stock that is going down, a loser, loss aversion makes you want to hold it, because selling means admitting the loss is real as long as you hold it. You can tell yourself it is just a paper loss. It will come back. I just need to wait. And so you hold and hold and hold, even as it keeps dropping.
Oh, so you sell the things that are working and keep the things that are not working.
Exactly. And this pattern is so common that it has its own name. It is called the disposition effect. It was documented by researchers Hirsch-Schiefrin and Meyer-Statman. In 1985, they studied thousands of investor accounts and found that people consistently sell their winners and hold their losers. The mathematical opposite of what they should do.
Wait, so there is actual research showing that investors systematically do the wrong thing?
Systematically, predictably, across thousands of accounts, it is not random, it is a pattern, and the pattern is driven by loss aversion. The pain of realizing a loss is so intense that people will do almost anything to avoid it, including holding a terrible investment for years.
Okay, I have to be honest. I have done this. I bought a stock about 2 years ago. It dropped pretty quickly, and I have been holding it ever since, just waiting for it to come back to what I paid. Is that the same thing?
That is exactly the same thing, and it connects to another bias called the sunk cost fallacy. The sunk cost fallacy is when you say, I cannot sell now. I am already down 30%, as if the amount you have already lost is a reason to keep going. But here is the truth. The money you already lost is gone. It is a sunk cost. It is irrelevant to the decision you need to make today.
But it does not feel irrelevant. It feels very relevant, like, I paid $50 for this stock and now it is at $35. Every time I look at it, I see that I am down $15 a share.
I know, and that is the anchor your brain is anchored to the price you paid. $50, and it uses that as the reference point for every decision. But the market does not care what you paid. The market does not know what you paid. The only thing that matters is what the stock is worth today and what it is likely to be worth in the future. Your purchase price is completely irrelevant to that question.
That is hard to hear, but I think you are right.
And there is one more thing I want you to understand. It is called the break-even trap, and the math on this is brutal.
Okay, hit me with it.
If a stock drops 10%, it needs to gain about 11% to get back to where it started. That is not too bad if it drops 20%. It needs to gain 25% starting to get harder. If it drops 30%, it needs to gain about 43%. If it drops 50%, which happens more often than people think, it needs to gain 100% just to break even 100% double.
Wait. A stock that drops 50% needs to double just to get back to where it was.
Yes, if you bought at 100 and it drops to 50, it needs to go from 50 back to 100. That is 100% gain, and that can take years. Sometimes it never happens. So when people say I am just going to hold and wait for it to come back, they often do not realize how steep the climb is. The math is working against them.
That is really sobering. So what do you do? Like if I am sitting here with a stock that is down 30%, and I have been holding it for 2 years hoping it comes back, what should I actually do?
Here is the question I want you to ask yourself, and this is the most important question in this entire episode. If you did not own that stock today, if you had never bought it, would you buy it right now at this price?
Would I buy it today if I had never owned it?
Yes. Forget what you paid. Forget how long you have held it. Forget the loss. Just look at the stock as it is right now. At this price, with this company's current situation and future prospects, would you buy it today?
Honestly, no, I would not. The company has not been doing well, and I do not really see it turning around.
Then why are you holding it?
Because I do not want to admit I was wrong because selling makes the loss real, because I keep hoping it will come back.
And that is loss aversion talking. Every single one of those reasons is your brain trying to avoid the pain of a realized loss, but the loss is already real. Patrick. Whether you sell or not, the money is gone. The only question is, do you want your remaining capital working in something you believe in? Or do you want it sitting in something you would not buy today?
Okay, that is a really powerful reframe. So the defense against loss aversion is not willpower, it is having rules in advance.
Exactly. The best defense against loss aversion is preset rules you decide when you will sell before emotions are involved. Maybe it is a rebalancing schedule. Every quarter, you rebalance your portfolio back to your target allocation regardless of what is up or down. Maybe it is a predetermined criteria. If the fundamental reason I bought this stock changes, I sell whatever the rules are. You write them down when you are calm and rational, and you follow them when your brain is screaming at you not to.
That connects back to what we talked about with the behavior gap, philosophy before crisis, rules before emotions.
Same principle, different application. Your brain will always try to trick you into avoiding short-term pain. But in investing, avoiding short-term pain almost always creates long-term damage. The investors who do well are not the ones who feel no pain. They are the ones who have systems that prevent them from acting on that pain.
All right, so here is your homework for this week, and I think this one is really practical.
Review any investments you currently hold for each one. Ask yourself, if I did not own this today, would I buy it at this price? If the answer is no, you may be holding it because of loss aversion, not logic. You do not have to sell. Just notice the bias. Awareness is the first step.
I am definitely doing that tonight. All right, let us lock in the takeaways.
Number 1. Losing money feels roughly twice as painful as gaining the same amount feels good. This is brain chemistry, not weakness. It is called loss aversion, and every human being experiences it. Number 2. Loss aversion causes investors to hold losers too long and sell winners too early. This is called the disposition effect, and it is the exact opposite of what builds wealth. Number 3. The purchase price of an investment is irrelevant to whether you should hold it today. Only the current value and future prospects matter. Your brain anchors to the purchase price, but the market does not care what you paid. And number 4. The best defense against loss aversion is preset rules. Decide when you will sell, before emotions are involved. A rebalancing schedule, predetermined criteria, written rules. Systems beat willpower every time.
If this episode made you rethink how you handle losses, follow Calm Investors wherever you are listening and share this with someone who might be holding a stock they would never buy today.
Thanks for listening, everyone.
Stay calm, build wealth.